on our valuation on January 24th, 2014, we've assigned a target buy price of $48.43, giving us a 12.73% premium to Mattel's stock price on January. Mattel is the world's largest toy manufacturer. They separate their products between core versus non-core products. We have assessed one of Mattel's biggest strengths is their variety and diversity of products. Are growing market share in terms of revenues, which they are already the industry leader. Improving operating margins, which have been hovering and growing about 50% for the past 4 years. And creating long-term shareholder value. The company is led by tenured loyal management, namely Brian Stockton, the chairman and CEO, who has been with the company since 2000. That being said, I'm going to turn it over to Henry, and he is going to talk about the industry overview in terms of industry.
Thank you, Evan. Mattel participates in the gaming toy manufacturing industry. This industry produces products such as electronic toys
So the moment we've all been waiting for. Why and how does Mattel have a target price of $48.43? Well, as Henry mentioned, Mattel is a mature company. And for mature companies, we predominantly use the DCF model. Well, we also decided to use a secondary model, a relative valuation. Moving on to the DCF model, our most important assumption in the DCF model is our revenues. And I'm here to tell you today why Mattel is in a great position. The international growth of domestic and emerging markets are accelerating at an all-time high, while the spending cost per toy is at an all-time low. This creates an implied value for the international sales of Mattel. Domestically, the American middle and upper class are continuing to grow and will continue to grow over the next 5 years. As well, Mattel's digital penetration is increasing. We see this in 2 ways. One way, the physical to digital presence of the product. Barbie is now being turned into a Barbie webisode that can be accessed by young children. And we also see the most popular video game of our time now, Minecraft, for young teenagers, being converted into a toy. With those revenue drivers and also the risk analysis that Colin will explain, we have a conservative revenue growth of 4%, and we have a $48.79 per share target price at January 25th. Moving on to the relative valuation, we use 2 industry standards, PE ratio and EV/EBITDA multiple. As you can see from the wide spread that this is a secondary valuation to the DCF. Moving on, while using estimates for the PE and EV/EBITDA multiple for the years 2013 and 14, and assigning equal weights to the years and to the multiple, we come up with a price from relative valuation of $46.36. So, with that being said, those 2 valuations compromise
So yeah, so from top line, this is where your top line revenue is, and as it builds down the income statement, that's where the net income / the unlevered net income.
So kind of to the right of the line is where you're doing your projection.
Exactly.
Yes,
That's
and that's the 4%.
Yes.
And it's not 4% year to year. We tapered it, so we went from a 4.5 down to a residual to 2.
And what's your assumption on growth and cost of goods sold and the rest of it?
So what we did for cost of goods sold, we did margins. So we have the gross income margin, as Janet reviewed, the gross income margin, which is the gross income over revenue, and then the difference between that being the cost of goods sold.
So you have that increasing from a current, was like around 53 up to 57 and a half.
Yeah, it's primarily because of the global cost leadership program you mentioned. They're expecting their operating margins to increase, and that's why we implemented that in our CF.
And when did that start?
2008.
2008.
2008, and it's going to continue all the way to 2015, 2016.
You commented that a lot of these games and other stuff have short spans. And in the summer, you come to a new pipeline project. How do they develop? I mean, they got an R&D department, they have somebody, like a movie gigs, and just somebody there trying to figure out how to come up with the next best game. What do they do?
So a big thing that they do, they receive registered trademarks through companies, entertainment companies such as Disney and DreamWorks. So if those companies are putting out products that are products as in movies and television shows that are successful, Mattel usually has, right now they have deals with those companies that they have first dibs on receiving registered trademarks to create toys for those companies. So that's how they create their pipeline. They also acquired Hit Entertainment in the early 2000s, which are shows such as Bob the Builder and Thomas the Tank Engine, which are, for very young children. And that's how they keep those pipelines going through their business relationships with these entertainment companies, and through their core products, which have been successful for decades now.
How did you guys pick your inputs for the cost of equity? Because it seems like you show the companies better and debt to equity, but they're different from what you selected. So I was just wondering what your thought process is.
So you're saying the 9% here for
For
cost?
example, the beta for the company that you're showing at the front page is 0.7, you selected one. Then debt to equity ratio, you mentioned 50%. You picked
Yeah.
something that's much lower.
So basically it's levered and unlevered. So the one on the front page is the levered beta before we unlevered it through the discounted cash flow. So what we basically did is we took the competitors and we took the beta of the average of the competitors, and then we unlevered Mattel's beta with Mattel's debt to equity ratio. And then after we did that, we used the debt to equity ratio of the average companies and the competitors, and then re-levered the beta to be 1.087 for the discount, for the DCF analysis moving forward.
And adding companies such as Electronic Arts makes it a little more volatile because they are in solely the electronic gaming business, which is a little bit more of a volatile industry, whereas this is a little more diversified.
What's the biggest risk you see? What could blow up with those companies?
Well, yeah, we took the liberty of creating a risk analysis matrix where basically we weighed the magnitude of an event occurring versus the probability of it occurring, and created a graph. Disruption of international sales, especially with the kind of all the current events that are going on right now, and also disruption of international production. Currently, Mattel operates production units in 10 different countries, either through foreign subsidiaries, wholly owned subsidiaries, or third-party manufacturers. So we believe that those would drastically affect the business, especially if it occurred during a peak sales time, such as the holiday season. One thing we did like about Mattel, though, is as you can see, there's not one risk that kind of stands out that's really likely to happen, and it's going to really negatively affect the business. We believe that Mattel has done a good job of mitigating any risk to the company, and we see it being successful in the upcoming years.
Can you go back to the DCF model? Looking at free cash flow on slide, I guess on page 6, from 2015 to 2016, jumps up off 50%, 861, 1168. Notice working capital went up quite a bit. What's driving that?
So here, on 2016-17, what we had to do is we had to take, current assets minus the current liabilities, and with the projections, we didn't have much. So what we decided to do as a group was take what we saw them doing before the financial crisis, because still seeing that they're, not in full recovery mode because they weren't as affected, but before when they were doing really, really well, and almost model what we think they will be moving forward post 2015.
It seems like it's a little bit of a conflict because if they're investing in digital, and I'm not sure that's going to CapEx or that's going to line item. Could they sustain those cash flow if they have invested in so much money in digital?
Yeah, so one thing about the digital too is, for example, for some of their digital webisodes, a lot of it's like licensing agreements. So instead of it happening in-house and apps for whatnot, what companies will do is, reverse license is license from Mattel, say the name for Barbie, and be creating the webisodes. So instead of it being a capital expenditure, it would be an expense.
Also, I would like to add that they're doing this as a complement to the toys, not that they're ignoring the toys and just switching to digital. It goes together like as a package, so it wouldn't be one over the other.
Can I ask a question, maybe switch gears a little bit on the risk dimension? And look, I don't know Barbie very well, I've never visited. You were saying you visited them. But
I play with Barbie.
my sense is, right, toys are shifting to much more of a digital thing, like you guys mentioned, and they're clearly making some obviously efforts to try to do that. But I would have thought one of the risk dimensions is it like Barbie or Barbie-related things a fairly big proportion of their revenue that they're getting? And Hot Wheels, some of those older toys. So one question I would have in looking forward, right, is what's the growth in these, kind of older but high visibility products that they've been able presumably to grow and leverage very effectively? How do they transform into a digital age? I mean, do kids like Barbie digital just like they liked Barbie 30 years ago? And is there a concentration impact by having, I think of Mattel, you think of Hot Wheels and Barbie, right?
Yeah.
Sorry, I'm sure that's simplified, but.
Yeah.
Yes.
I can take that question, actually. So like, for example, Barbie, it's not doing as well as you've seen from like the previous reports. And that's mainly because there's also been a shift in the culture of girls not wanting more mature Barbie dolls, but more of like the bad Barbie girls. And for that reason, actually, one of the things that's really cool about Mattel, they've been really innovative. And they started coming out with their own type of brands. Like they recently came out with Monster High, which is doing, they recently came out with Monster High, which is like it's like a Barbie doll, except it's like a monster type of, and they're more not as good. And so girls are into
Like zombie Barbie?
Yeah, zombie Barbies, like more of like the emo type of stuff, and that has really hit off really well. And so all that reduction in revenue from Barbie is actually being added on by Monster High, and they've made webisodes that are shown online. The girls go online and see these episodes or see them on their iPad, which has been really successful, and it's actually hitting the shelves more than actually Barbie. So there's just been a shift in the trend, and Mattel's taking on that shift.
And Janet,
We're going to call time.
Great.
Thanks very much.
As we all know, cash is the king. Mattel generates a large amount of cash. As we can see from the chart, Mattel generates almost twice as much cash as their main competitors, Hasbro. But some of you might ask, that's because Mattel got a large cap. The answer is yes. But as we look at the cash as a percentage of the total assets, Mattel still get a higher percentage number than Hasbro. And
So what was, I didn't follow that. What's $1.32 and 64 cents? Is that cash per share that's generated?
sorry, what's that?
You've got $1.32,
Oh, that's a
Total assets.
1.28
And the
billion.
percentage is the percentage of.
Total assets.
Okay, got it. Thank you, I'm sorry.
Should we go on? And the investor only cares about the cash to show on shareholders. Mattel's continues to deliver large amounts of cash to shareholders by two ways. The first is the dividend, and the second is the share repurchase program. Mattel, as we can see from the chart, the dividend yield of Mattel performs better than Hasbro 7 years out of the recent 9 years. And the holding period return materials keeps in a stable level than the hospital and their markets. Another way is that the share repurchasing program. Material continues their share repurchasing program since 2010 and accumulated cash ready to do the share repurchase program has reached 1.5 billion US dollars. So overall, Mattel spent 71% of their cash generated since 2004 to the shareholders. And those cash comes from the revenues. Mattel does a stable growth of the revenue throughout over the years. However, hospital their growth is up and down, especially in 2012. Mattel's goes up in 2.4%, but the hospital gets down 4.7%. And this year, hospital also going down and Mattel still going up 1%. Let's introduce Anu to talk about the future opportunities of Mattel.
Thank you, James. So as James spoke about the revenue of Mattel, in order to keep growing, they need to keep increasing the revenue and to keep getting more cash. Mattel identified 4 different ways in how they can keep increasing the revenue. They've opened up a new production house, which is called the Playground Productions. They're going to produce their own movies. They've also renewed their contracts with major companies. In fact, recently they renewed their contract with WWE. Also, they're innovating. They're coming up with new products for them to increase the revenue. And what they're doing with the old products like Barbie and their Hot Wheels is that they are revamping it. They're coming up with new designs. They're coming up with customized designs, so you can customize the product as you want, especially Barbie. The other area where Mattel sees future growth is the international market, especially the BRIC countries. I mean, BRIC countries constitute about 40% of the world's population. And they expect that around 400 million potential customers are going to come in the next 5 years. So this is where Mattel identified. The numbers that you see on the screen are basically the revenues in 2012. So around 44% of the revenues was from the international market. And in 2013, the revenue from the international market went up by 5%. I'd like to introduce Chen to talk about cost control.
From the perspective of from cost controlling, we also evaluate Mattel's cash performance by cost saving. We noticed that Mattel's cost decreased significantly since 2009. From this bar chart, we can see that Mattel's S&G and advertisement as percentage of sales was flat across the past 5 years. At the same time, Mattel's costs as percent of sales decreased significantly. The cost saving was mainly resulted by Mattel's operational excellence program, which was initiated in 2009. Mattel's operational excellence program exceeds its expectations. It is also because OE program, and it is designed to improve its operating efficiency and profitability. And until 2013, Mattel has launched 3 stages of the excellence program, which include Global Cost Leadership Program, OE2, and OE3. All these 3 stages exceed its target. In 2014, Mattel will continue to run its operational excellence program to cut its cost and generate more cash to its shareholders. Then you will talk about the valuation part. Thank you.
Here we come to our valuation part. Basically, we use the 3 methods to do our valuation: discount cash flow, exit EBITDA multiples, and PE multiples. And we can see that the results are almost the same, so we just average them and get our target price, $52.1. And also we did some sensitivity analysis. For each method, we gave them a worst case assumptions and see how the price changed under these assumptions. And we can see that only for PE multiple method, the worst case price is lower than the market price. So we somehow can say that the market price has been undervalued. And finally, we will arrive at our conclusion. The stably increasing revenue, the opportunities Mattel has, and their cost control plans give Mattel a large amount of cash. And Mattel deliver this cash back to their shareholders. So we conclude that it is a wise choice for investors to buy Mattel. Thank you very much.
Any questions?
Sure, do you have for a reference, your DCF?
This is our assumptions.
Is that 5.2 going forward, or is that just 1 year?
It's across the next 5 years.
5 years.
The long-term growth rate of 2.74 or 2.75.
What was cost of goods sold in 2012 as a percentage of revenue? I think you have it somewhere.
Yeah, that's just slide 10.
In this slide, it will be 46.9%
All right, and then you can go back to those blue ones.
Go back.
Yeah,
Okay.
So it's 46.9, then down to 46, okay.
5.2 seems pretty high, given that international is 5% and domestic is probably more than that, right? What's driving that 5.2?
Basically, we used the last 10 years growth rate except the 2008 and 2009 because that was financial crisis period.
In addition, we use their statements, quote, mid-single digits. That's been Mattel. That's not a bunch of Mattel product for the last couple of years.
Can you tell me about the competitors? It's very different, changing market.
I mean,
Who are we should be looking at?
I think Hasbro is the main competitor as well, right? And there are other competitors like Leapfrog, but they're 1/3 the size of Mattel. So we kind of thought that Hasbro is the main competitor for Mattel. Then there's also Lego, but Lego is a private company, so and it's based in Europe, so we did not include that in the valuation. But we did look at it, and again, we still say that Mattel is bigger than Lego also. I mean, Lego focuses just on one product. Mattel has brand portfolios under the belt.
Any disruptive content that's a concern? You met a small company, they have something. So what content, what kind of disruptive content might be out there?
On behalf of Lego, or on behalf of competitors?
Is there anything out there that's changing? It's a risk. Or a positive, there are positive.
Can we see that risk band out here? And I would answer that question too. There's one, like specifically with Lego, one of the trends that we spotted from the Toy Industry Association of America was that building sets were starting to increase a lot in terms of sales. So that's obviously Lego's wheelhouse. In addition, based on our research and a conference call with Mattel last year, licensing was a big concern. So if you're talking about licensing a hot product, licensing Star Wars that's coming down the pipe, for example, which Mattel has, and if you're outbid for a product that that could, really define the zeitgeist, like Star Wars toys may have done, a couple decades ago, that could create some problems.
I had a question on the dividend slide, I believe on number 5. You see that red line represents Mattel's dividend, and the yield is decreasing. Can you explain to me why that's happening and why I would essentially want to invest in a company whose dividend yield is going down while the other one is going up?
As we can see from the chart, not only Mattel's dividend yield is decreasing, as well their main competitors, Hasbro, their dividend yield is also decreasing. And as we can see from this, during the 2012 to the 2013, the decreasing range is, Hasbro got still higher than Mattel. So we conclude that Mattel still got stabilized the dividend yield.
Why is it going down?
And we think that in 2012, they had an acquisition. They acquired another company, so that made their cash less.
Who would they acquire?
Hit.
What's an entertainment company, digital content?
Is that the reason why, if you look at page 3 on our handout, cash is king? Is that why, because I'm looking at the trend, cash as a percentage of total assets. It's a little bit misleading because I see 20.47 in 2012. If you go-
This one.
Yeah, it says 20.47, there was no like bar chart that corresponds to that, and for Hasbro it's 19.64. So they're pretty close. Why is the cash declining? Is it because of acquisition?
But I mean, again, they're doing a share repurchase program, so.
But that acquisition is duly noted in its 2012 10K with respect to cash.
Are you also saying, given their dividends now are pretty close to each other if we compare Mattel and Hasbro, right? Are you saying that Mattel has a significantly larger share repurchase program than Hasbro has, for example?
I mean,
Does Hasbro have a share repurchase program?
no. I mean, Mattel is primarily focusing on giving cash back to the shareholders. So, I mean, one of the major programs is share repurchase. So, I think that's why the cash is going down along with acquisitions also.
And also, more slides on the valuation. Basically, how you came up with this target in the range. It's not.
And what peers did you use as a multiples? Just Hasbro?
Yeah,
Yes, just Hasbro, because again, we said like this, they are the closest competitor, other competitors were just 1/3 of Mattel.
What is the operational excellence? It's cost control. What do they do?
Actually, we can go to the. Yeah, actually, we can go to the operational excellence program. Actually, it is a cost saving program because Mattel wants to save the cash and to give the cash to the shareholders. So they want to cut the cost. So they just initiated in 2009. And at first it's called the GCL, which is Global Cost Leadership Program. And we can see that in 2009, it exceeded the target. And it will cut their cost in S&G and gross profit and advertisement. And in 2010, it's also exceeded its target. So it's very succeed in the first stage. And continue in 2011, 2012. It continues the OE2, and it's also exceeded its target expectations. So they continue to do now it's OE3, and we just finished it in 2013. And we can go back to the OE slides.
And I would like to add to that, they're trying to increase the gross margin, and
Yeah,
which
from
in
this
turn
one.
increases the operating margin. So, I mean, trying to give them enough.
What is it? Is it a global software program? Is it
It's
specific? What exactly specifically are they doing? Cut costs? Are they outsourcing? Are they? What exactly do they do?
Actually, they do actually doing something, for example, they're packaging the toy. They used to package the toy in the double size of the package, but they just restrict it to one single size of the package. So that's reducing the cost.
I mean, they're saving it through two ways, which is one is cost of goods sold, and one is SG&A. So they're restructuring their SG&A, and also they've also started off with this in 2014. In fact, they will start with making environmentally friendly products and use materials which are environmentally friendly. That's going to add up to 25 million in revenue. So that's going to be more cash and more sales. So that's how they're doing it. I mean, they're basically restructuring their entire costs and SG&A.
What's your valuation slides in the appendix? Show the summary of your.
We have this is assumption, and the
and the free cash flow so much more. I guess what are the differences in those two figures?
Good afternoon, ladies and gentlemen. My name is Ahmad Khalil, and these are my partners David Tushin and Diego Bolton. We will be representing research team number 3. So today we'll be discussing our research and analysis of Mattel. They're a great company based out of El Segundo, California. They're one of the largest toy manufacturing companies in the world. They have about a market capitalization of $60.5 billion. Their current share in the market in the toy industry is 16%, nearly double that of its nearest competitor, Hasbro. Now, some of their recent significant developments have been that their worldwide net sales have increased 1%, and along with that, they're also hitting $7 billion in sales. Now, based on our analysis, we're going to warrant a buy recommendation at a 12-month target price of $44.91, which is about a 16% appreciation of its current market price. And some of the reasons why we chose to warrant a buy recommendation is that we believe, as the largest toy manufacturing company in the industry, they are undervalued. You know, they have a huge share in the market. Second is that Mattel, we believe they have a sustainable brand portfolio. They have their brand portfolio separated into 3 main components. One being Mattel Girls and Boys brand. That includes popular brands such as Polly Pocket, Barbie, Hot Wheels, very popular brands. Second is the Fisher-Price brand. Those include Dora the Explorer, Mickey Mouse, and other Fisher-Price products. And thirdly, their recent luxurious brand, the American Girl brand, which is doing phenomenally right now. I think recent sales were up 11%. That includes the American Girl and Bitty Baby. Now, also the third reason why we're warranting a buy is that there are potential emerging markets in Southeast Asia, South America, and Central America. The middle class is rapidly growing, and these children are going to want to buy toys. So we believe with Mattel's 16% market share, they can capitalize on this and definitely increase their sales and revenues within the next couple of years.
What was that thing you mentioned, Bitty Baby?
Yes, Bitty Baby is one of them, yes. So for our valuation, we use the discounted cash flow, free cash flow model to evaluate Mattel, and it has its advantages and disadvantages, and so on and so forth. So now I'm going to hand it over to David, who's going to discuss his financial analysis. Thank you.
So, as Ahmad said, it is one of the largest toy companies in the world. In 2013, they did $7.1 billion in sales. They are a large cash-generating machine with a gross margin of 54%, which is actually up from 50% in 2010. They have really low debt with a debt-to-equity ratio of 53%, and they give back to their shareholders. Their dividend yield last year was 4.28%, with a compound annual growth rate of 20% on the dividend. Now, one thing that was troubling was their efficiency has decreased recently over the last 3 years. Their accounts receivable has stretched out to 102 days, primarily also due to holding inventory for a longer period of time, even though they use the just-in-time management philosophy. This has increased their operating cycle up from 81 days in 2010 to 151 days. Now, it's because of their strong brand portfolio, they still do have a large institutional investor base of 95%. And in 2012, they acquired HIT Entertainment, which is a preschool toy manufacturer. The primary brand there is Thomas and Friends. In 2012, they wrote off acquisition costs of $29 million, and in 2013, $9 million. The fourth quarter results were really lackluster. They came out last month on the 31st, and the stock actually depreciated by 10%. That was primarily due to a really soft toy market. In the U.S., toy market overall was down 1%. It was really flat in Europe. People are choosing more e-commerce stores and less from the brick and mortar. Those lackluster results, and in terms of sales in general, with Mattel, in North America, sales were down 10%. Yet that was balanced by Asia Pacific, which was up by 5%, and Europe was up, which was also up by 2%. The gross sales, as I mentioned, was $7.1 billion. Globally, it was up 1% from 2012. Their gross margin went up 50 basis points over the last year, and their earnings per share would also increase 4% to $2.58. They have cash on hand of $1 billion. And what they're doing with that cash is the board of directors approved a stock repurchasing program back in 2010. And since over the last 3 years, they've purchased about $1.5 billion worth of, basically common stock and treasury stock, which is about 52 million shares. We recognize that Mattel may continue this repurchase trend in the future, and we also accounted for that in our valuation. We also looked at the commitments. In 2012, Mattel's commitments were over $1 billion, primarily due to inventory acquisition and long-term debt. And that was actually, 2013. And in 2014, this year, it's down to $252 million for commitments. They don't have any long-term debts or notes to pay out or anything like that. So there's obviously a little bit of room there. They also have a cost savings plan that they implemented about 3 years ago as well, which was about $400 million gross savings. Primarily focuses on manufacturing and operational efficiencies, reducing advertising expenses, and sales and general administrative expenses. One of the important things that we also looked at was management compensation. Sales growth for this company over the last 3 years has really been stagnant, or 2 to 3%, primarily due to their strong brand portfolio, or legacy brands, if I'll call them that. There's really no pressure from stockholders in the marketplace to really increase that number. And we looked at the total compensation for executive compensation, primarily for Mr. Stockton, the CEO. In 2010, he was making $4.1 million, which quadrupled to $17.6 million last year, which is primarily based off of long-term incentives such as stock options, and it's tied to total shareholder return. And we really find that Mattel has unexploited assets and really no plans for ancillary revenue, such as licensing and movie deals on the scale that their competitors such as Hasbro does. And for this reason, we find that Mattel is really undermanaged. We believe that they're capable of growth in the 4 to 5% range. When we've plugged that into our DCF, we actually think they could beat our valuation of the $44.91, which is a separate thing. But overall, because they're undermanaged, they don't find those ancillary revenue sources. We also believe that they're a prime target for an M&A acquisition from a larger company, which could actually sweeten the pot and raise their target price. So Diego will talk about a little about those risks as well.
So I'm going to be covering the risks with Mattel, and as any company goes through, there are certain risks that need to be evaluated and understand how those risks are actually being mitigated. So we looked at the main four risks, which is market, operational, economic, and operational risks. So with market risk, we understand that it's a growing trend that children seem to be getting older faster. So it's more prone that a child will actually get a tablet for Christmas rather than the next Barbie. So I mean, to hedge against such risk, they're implementing tech into the toys, providing softwares, any kind of plug and play that they're trying to do. And because they operate outside of the U.S., they're exposed to foreign exchange rates. And to combat these, they provide foreign currency forward exchange contracts to lock in the prices in order to protect themselves and shareholders. And while they do control 16% of the market, they are competing in what's known as a shrinking market. So we look as well as the economic risk. Any kind of increase in commodities could, affect their operation. If the price of plastic were to go up, or the price of petroleum were to affect how their toys are actually being manufactured, it could adversely affect the production. Anticipating trends is always an issue for any company. Forecasting out what's going to be the next big hit for children. And most of their sales does come from the holiday period, so they are a cyclical company. As far as operational risk, operating outside of the U.S. does provide incentives to any company, but it does have to come with a heavy hand. They do not follow certain regulations based in the U.S. because they're operating in so many different countries. Regulations are, left and right, different all over.
You may want to flip the slides because you have one of the individual ones.
Oh, yeah. Forget I'm talking and clicking. So, operational risks, include that, operating in the foreign country does create some risk. We remember recently in 2007, Mattel actually recalled a large amount of their China toy products because the high lead content in the toy paints provided a risk to small children. And the legal risks are also important to evaluate. They've had constant feuds with MGA. They're over the coveted brand. MGA is another toy developer actually. So they're competing over the coveted brand of the Bratz doll. So recently in 2014, they were a lawsuit was put against it for the trade secret theft of the products between the Bratz and the Barbie. So these are some of the risks. So in conclusion, we understand that they have a strong legacy brand portfolio. They have high profit margin, 54%, and appealing low debt as a company. And the low cost of sales is all done through their in-house manufacturing.
And we understand that the potential in the emerging markets is where Mattel will potentially see its most significant growth. And we believe these assets are unexploited for that reason. So we understand that it's undermanaged, and we believe it's undervalued currently by the market. So, and it makes a great M&A target again. That was our biggest point. This is what our analysis and our research concluded, and this is what we believe warrants a target price of $44.91. Thank you.
We were looking at Disney possibly. They could purchase their brand. It's literally sort of a self-starter, if you will. They have not been doing much with their brands, pushing them. They're the same legacy brands. We foresee people still playing with Barbie in 10 years from now, but we don't know if that will happen in 20 years from now. That was our primary company that we looked at.
Yeah, and recently Sports Illustrated actually came out as Barbie was on the cover of the magazine. So I mean, it actually rose. The price of the Barbie was, I think it was selling at $19 in stores, but it managed to drive the price up to $69. So it was a really interesting point to go around. I mean, it's potential for any big company, I believe, personally. It could be a Disney or a Universal. I mean, I know Universal has deals with Hasbro since they do a lot of the Transformers ride. So I mean, there's just not that much incentive for the company, I believe, to really go out and push the development of this company.
Do you have your DCF model that we can see?
We didn't provide it in the PowerPoint. It was just in the research.
Can you walk us through some of the assumptions in your DCF, maybe, if you don't
Okay,
have
yeah,
like revenue growth, margin growth, things like that, just so we can get a sense of.
Okay, well, some of the assumptions we made, well, basically our main assumptions is that we assumed that it was a stable, well, it is a stable growth company based on like the past historical data. And basically we assumed a growth rate of 3%, which was a little reserved, but it's fair. And yeah, so generally the growth rate of 3% was in capital expenditures, depreciation, and in revenue. And yeah, basically, as we also discussed earlier, if they're able to increase that growth rate, it could adversely affect the 12-month target price. So we know we plugged in numbers, and it's a lot different, a lot higher, and makes it much more desirable to stock.
What did you project out for cost growth? So you got 3% revenue growth, right?
Yeah.
And it's over 10 years, I think.
Yes.
Right? What about cost growth over those 10 years?
Cost growth was, the growth in cost was at, I believe it was 4%, 4.5%. Is it 4 or 4.5%?
Really?
Yeah.
So the margins are shrinking?
Margins were,
The revenues probably.
I'm sorry, it was actually a little bit less. It was 3.5. You said 3?
Yeah, you said 3.
No, 3, it was 2.5, I'm sorry. Because the margins were actually increasing, because that's what's been happening. Their gross margin's gone from 50 to 54. We actually saw an increase because they're actually reducing their expenses, especially with their
Cost savings.
yeah, their cost savings program that they've implemented.
Do you remember what happened to margin? I mean, how high did it go up over this 10-year period?
The highest that we saw after 10 years was, it was like, off the top of my head, I want to say about 57, 58%.
That's kind of consistent with what they're projecting, isn't it? I mean,
Yeah, absolutely.
This cost savings program, at least the cost savings side of things, right?
Yeah, I mean, I would foresee them to actually increase their cost savings plan, their program, if you will, in the next upcoming years as well. But I just want to see them be more aggressive, management be more aggressive, because I think there's more opportunities out there than what they're pursuing.
So sure, then, what are you looking for?
From management,
Wait, is the CEO retiring?
no, I think there should be executive. They should look at the executive compensation, possibly have that committee review executive compensation and reevaluate the just executive compensation.
I mean, it's an interesting point to bring up that their leading competitor, Hasbro, has about 35 times as many less employees. So they manage around 8,800 employees, while Mattel manages around 20,000 employees. So we had difficulty spinning around, our head where exactly those 20,000 employees are really doing if all their manufacturing is in-house and it's done through independent contractors outside of the U.S. So it's just an interesting point to bring up that he started in 2010 at around, I believe, 4 million, and it went up over 4 times, so up to 17 million. And with sales and growth, it hasn't really been consistent with the increase in pay.
You don't mention any multiples valuations, so you choose not to rely on that? Just the same?
Actually, based on our expertise, our team's expertise, we understand that there are other evaluation methods out there, such as multiples or comparative. But based on our expertise, the students and where we're at, we're more comfortable with the DCF. We don't want to stretch our capabilities, and Ahmad can kind of discuss some of the advantages and disadvantages of.
Yeah, well, now some of the advantages of using DCF, well, it's one of the most standard methods of evaluation. It's pretty reliable, and it's also based. The main point is it's based on future expectations, not current results, and that's what we were looking at, because we saw Mattel as a company that can achieve a lot of great things within the next few years. So yeah, so we wanted to focus on future expectations, and also it's also focused on cash flow generations, and so basically any flaws in accounting methods or manipulations there wouldn't be affected. So we can basically focus on the cash flows.
My favorite part of this presentation was in market risk. There's a sentence here: children are getting older, younger.
Yes.
You guys hang out with Yogi Berra, or? Anyway, on that same slide, there's something here that says foreign exchange currency risk. That's listed as a risk.
Yes.
What does that mean?
So when a company's out, in different international markets, there is the volatility of the foreign exchange market. If the yen were to change drastically or were to drop drastically, it could adversely affect the transaction over to the US dollar. So in order to mitigate that risk, they actually provide forward-looking foreign exchange contracts. So they lock in those prices in order to protect themselves, their assets, and rippling down to the shareholders. So.
I think that story for me is like the disclosure of emerging markets. At what point do international sales of emerging market sales surpass that of domestic and developed countries?
Well, currently, Mattel sees around 46% of its actual sales coming from foreign exchange markets. And that's typically because, as more more countries are becoming industrialized, and, the middle class is growing in countries with a younger population. Here in the United States, we see a shrinking younger population. Because baby boomers are on their way out, it's a smaller birth rate here. But in countries where there's a higher birth rate and, a higher prospect for children and parents, to be able to finally afford the toys that they're actually alienated from, that happens, with manufacturing. So it provides the potential in foreign markets, really. That was our conclusion from that.
Right, because in China, like, the birth rates all over China, that population's been declining at some point, but also you have India, Brazil. Are those countries more open to, buying a foreign brand, or specifically Barbie dolls?
I personally believe that it's always the appeal towards the westernized side of the world that really draws people into buying the Barbies, the Hot Wheels, versus the local toy brands. So it was to my best ability to explain that most of the potential coming in foreign markets is because of the fact that it's becoming the standard of living is being raised, and that's an important point to make. So while China is experiencing a decreasing population, they're finally seeing the freedom to exercise more of their money, and it's not where they're only manufacturing. They're not just manufacturing anymore. They're becoming part of the consumer market. So that was an important key point to make.
What percentage of the revenues are solely Barbie? Maybe, I don't know if you addressed that. And how do you just see that component of the business growing over the long run?
I don't know the percentage off the top of my head.
Yeah, but I mean, well, with the recent Sports Illustrated magazine, I can see definitely that whole Barbie cover magazine, that's definitely caused a lot of buzz.
Mm-hmm.
So yeah, we can see recent in the next year probably sales are increasing in Barbie, and I'm sure I have a feeling they're gonna start making some moves towards that because we're starting to lose the whole Barbie scene. So they're probably gonna try to bring it back in and integrate it a little more.
I mean, it's a 50-year-old brand, and they had numerous movies over the last decade or so. But we haven't really seen anything too recently other than this really PR push on Barbie recently, the swimsuit magazine here. Sports Illustrated. So I mean, I foresee that, like I said before, little girls are not going to stop playing with Barbie in the next 5 or 10 years.
Yeah, I actually saw a recent article that they're revamping how Barbie is seen. They have
the woman Barbie, well, it's only Barbie's a woman, if you don't count Ken, but what we saw is that they actually had the women in business as the Barbie. So that was a new thing that they came out with to encourage really young girls to aspire, and dream big. So that was what we saw. That's a good move from Mattel, and it's their whole slogan is creating the state of play. So.
Essentially, the biggest selling point for this top casual appeal is you're waiting for management to do something. M&A's kind of always crash. It looks like I'm waiting on management to do something because there's a lot of potential under. So I'm still not sure why I would buy this company if I'm waiting for management to change. You see that? How do you approach that?
We still feel that it's a buy. That was just sort of you would purchase this company because it's undervalued. There's emerging markets and it has a great portfolio brand. That's the reason why we purchase the company right now. It's going to appreciate 16% the next year. What my point was that it is an undermanaged company and they can outperform our analysis of the $44 target price. That's what I was trying to get across.
So if you're out of time, sorry.
Okay.
I'd like to thank the CFA Institute for hosting this event, FactSet for providing us with valuable data, and the CFA LA judges for being here today. We are Team 5. My name is Alyssa Gustafson. This is Cody Van Boxtel, David Larson, and Jason Koss. As of January 30th, 2014, we initiate a sell recommendation on the company Mattel with a 1-year target price of $40. This recommendation is consistent with the company's year-end earnings release. Our two primary reasons for this sell recommendation are the company's weakening sales growth and unfavorable toy industry trends. Mattel is a market leader in the global toy and game industry with 12.4% total market share. The company divides its products into 3 brand portfolios: girls, boys, and infant preschool. The girls portfolio is the company's largest, with Barbie as its flagship brand, Monster High as a recent sales success, and American Girl a strong franchise. The boys portfolio contains the company's core brand Hot Wheels, and the infant preschool portfolio consists of Fisher-Price and Friends and Thomas and Friends, which was recently added with the company's acquisition of Hit Entertainment in 2012. Looking forward, we have observed several key industry trends. The first is a paradigm shift as a result of children becoming older faster. This means that children are moving from physical to digital toys at a younger age, causing a redefinition of what a toy truly is. This trend has caused interactive gaming systems that blur the lines between physical and digital toys to become increasingly popular in the past years, and we view that these toys offer insight to where the toy industry could be headed in the future. Another key trend we've observed is the effect the 2008 global recession had on birth rates in mature markets. As a result of a decline in these birth rates, we are seeing fewer children today and therefore a smaller target market for toy companies. As these mature markets become less profitable, toy companies are beginning to look to emerging markets which have rising disposable incomes and emerging middle classes as their largest opportunities for growth. However, we note that large toy companies offer quality products that come at high prices and therefore are still considered luxury items in these countries. As a result, we believe that large toy companies will need several years to realize significant gains in these regions to make up for their losses at home. I'll now hand it over to Cody, who will explain how we factored these considerations into our valuation model.
In order to value Mattel, we first need to understand how the company has performed in the past. We started by analyzing 20 years of financial data in order to capture multiple market cycles, and we use that to project a 10-year pro forma analysis. We use the discounted cash flow to equity and residual income valuation models in order to value Mattel's intrinsic stock price. As of January 30th, Mattel is trading at $43 per share, and we value the company at $39 per share, and this was on the 50th percentile of the Monte Carlo simulation. One of the key components within the valuation model was Mattel's forecasted sales growth. We used regression analysis linking Mattel's historical growth rates to the real GDP growth rates in the primary countries that they operate in. We then conducted Monte Carlo simulation to find the average sales growth, and we believe that sales will be between 2 and 3.5% in upcoming years, primarily due to declining sales growth in North America, relatively flat sales growth in Europe, and potential growth in emerging and frontier markets. We modeled
International sales represent 60% of Mattel's total sales by 2024. This is in line with management's goals and the current market conditions. We believe that we took a relatively conservative approach in valuing Mattel's sales growth, and we modeled the long-term growth rate below the average growth of the economy. A second primary component within our model was that we wanted to find a distribution of the price rather than a point estimate. This led us to conduct Monte Carlo simulation on the key income statement, balance sheet, and cash flow statement components, and we modeled all those to be within their historical range of values. Finally, we used multiple methods to come up with the cost of equity for Mattel, and we had that cost of equity increasing every year in our forecasting model in order to incorporate a higher level of risk and uncertainty. With all of that, we came up with a $40 fair estimate price 1 year from now, and that's also based on the 50th percentile Monte Carlo simulation. With this, I'll turn it over to David. You can talk about our risks.
Thank you, Craig. So when we're modeling the risks, what we wanted to look at is 20 years of risk. So they faced a lot of different risks over the last 20 years. They had recalls and different risks like that. They have different acquisitions that didn't work out as well. But the key risk that we saw going forward was actually their sales decline. We see this most favorably in 2002 to 2012. You actually see a decline from $2.5 billion to $2.4 billion based on their retail base here. These are their main customers, Walmart, Toys R Us, and Target. They've changed the way they buy toys. They buy just-in-time inventory, and they've cut their own inventory. There's also been two major bankruptcies that have affected Mattel's earnings, KB Toys and Woolworths, UK retailer as well. So with this market going forward, this shows a very competitive market because Mattel is the market leader, but they're not able to move sales within this core market. So that was a major red flag for us as we were going through the financial statements. As Alyssa mentioned earlier, the declining growth rates is something else that we saw. This is a graph from Gapminder. You can see the net income per capita has changed a little bit, but mainly what we see is the recession actually had a structural impact on the growth rate in the United States, and we feel that it also had an impact on the rest of the world as well. So we see a declining growth rate. This also shows up in Mattel's data. So there's a little bit of correlation between that. So in Fisher-Price, in 2007, they had sales of $2.44 billion. Today, in 2012, or actually in 2012, they had sales of $2.25 billion. So that's a decrease of 7.7% in their Fisher-Price core brands. We feel that the declining growth rate has something to do with that. And also, another risk that we see going forward is Mattel's own brands, brand weakness. As you can see here, this is something brand new that Mattel actually put Barbie on the cover of Sports Illustrated, which we thought was really something new. It shows kind of their desperation because, as you can see with most recent earnings, Mattel's.
What is this, by the way? Is that a billboard?
It's a billboard, yeah.
Yeah.
And they even went on Twitter and said unapologetic. So we feel that that's a major risk because, Mattel's Barbie has been their flagship portfolio. Their doll portfolio is very strong brand. So that's declining now. And we also see a decline in Polly Pocket with the most recent impairment. They took a $14 million charge, asset impairment on that. So we know the cash flow is slowing down there. Sales are slowing down. They also have product cannibalization when they have new dolls, Monster High, Ever After. It's cannibalizing their own doll portfolio. We also see increased competition from Lego with the new girls line of toys. And Hasbro recently reported earnings growth of 26% in their girls portfolio. So we believe that's taking market share from Mattel. And I will turn it over to Jason for the summary.
So in essence, we do not believe that the upside potential justifies the downside risk for this investment. We observed very weak fundamentals, specifically in Mattel's core brands and their sales growth with Barbie, Hot Wheels, and Fisher-Price. Barbie is actually one of the leading toys in the the doll portfolio, which is Mattel's largest portfolio. That's seeing a weaker trend towards declining and flattening sales. This is the same case for the boys portfolio. The boys portfolio actually faces a lot of competition from Hasbro, as well as the threat of technology on the whole. We have observed that boys are more susceptible to being swayed away from traditional toys towards a digital space. So we believe that this is firm specific, but also a trend of the industry on the whole. This is a shrinking industry. As my partner Alyssa said earlier, there's a paradigm shift right now on what a toy actually is. Is an iPhone a toy? We're not sure, but that definition of toy is being changed. So we think that with this lack in core brands, Mattel is too dependent on toys associated with movies, licensed toys. We don't think they're going to get the sales growth we think they need from that area. And in order to grow margins, they can either bolster sales with movie toys, which is risky, we believe, or they can cut costs. Management has expressed cutting costs in areas such as packaging and SG&A.
could be useful, but we don't think they can cost cut enough to bring those healthy margins that we want for the investment. So with this lack of innovation and technology threat, Mattel is basically left, if they don't innovate, to sell those same products to new people. We're seeing now in the domestic market a decline, a general decline across the board, as well as flat sales in Europe and other developed international countries. So that leaves a positive. Mattel can penetrate emerging markets. We see some saturation in Latin America, but Asia Pacific is still an area where Mattel could capitalize. Actually, an issue with Asia, though, is that they have they're lacking international intellectual property protection. So if Mattel sets up a store there and somebody sells a doll down the street for half the price, that's an issue for Mattel, obviously. Another positive we do see is Mattel does have a high dividend, and if that dividend yield gets high enough, it's going to bring in those Warren Buffetts, those Benjamin Graham's value investors to come in and actually set a technical price for, we believe, when that dividend is providing enough income. Although there are a few positives here, we think they're grossly outweighed by the negatives, and for that reason, we're issuing a sell recommendation for Mattel.
Thank you so much. We look forward to reading your written comments from the report, and we're really thankful for this educational opportunity. Now we'd like to open up for questions.
What percentage of the business is Barbie specifically?
Barbie specifically, the girls' portfolio is 45% of the company's business.
And the majority of that?
And the majority of it is Barbie, yes.
And so Barbie was down 6%, did you say?
Yeah, for the year, and 13% for the past quarter.
And so what you're telling me is you see that trend continuing over the next 5
Yes.
years, even as they're trying to revive it with billboards and...
Yeah, well, the billboard we think is quite a desperate attempt. I don't think that will appeal to young mothers. We don't think that that will increase, children liking it. So it's kind of a weird move on their part, but yeah, we don't think Barbie's going to come back.
So this company would have to have a pretty drastic change somewhere along the lines. What would make the difference?
Jason, want to answer?
We think acquisition or innovation, they have a lot of cash they could potentially acquire in a space, not necessarily the digital space, but a space where they can have a lot of product proliferation, either in new markets or couple those new products with existing toys. Besides acquisition, we think that they have to put more money into R&D and actually create new products.
It's hard to say. We listened to the conference call, and management was very apologetic on the most recent conference call. The conference call we had with them before, they seemed a little more confident, and they definitely want to return money to shareholders.
That's the quarterly conference call when they just released?
Yes, yes, we did listen to that as well. And they were apologizing for certain things and saying they were going to try to do better at retail. We think, on my side, the Walmart, and that's one of the biggest weaknesses we see, so they have to manage their retailers better and figure out how to really drive sales in the retail market. They talk about a lot of sales going to e-commerce, so they do have a website set up. They have Barbie.com and Mattel.com where customers can order toys on their own. So they're trying to push that market, and they've also opened up new international markets, Russia and more in Asia, but we don't see that. We see the decline in North America weighing more heavily on their sales than what they can grow internationally at this point.
And to add really quickly, specific to acquisitions, management expressed that they're not aggressively out looking to acquire. The truth behind that is speculative, but that was their view on that. So then that really leads us to the innovation side.
It would seem to me that one really big risk for any traditional toy manufacturer has to be the digital kind of revolution, right? Back to your iPhones are now a toy.
Right.
Kids play on their iPods and they play games more than do anything else, right? So, you say lack of innovation, technology, Fred, I presume that?
Yeah.
I don't know. So what is Mattel said about that? I mean, what's their strategy?
Yeah, I can answer
How
that
are they
question.
trying to address
Absolutely,
that?
absolutely. They said that they're trying to at least break even on some of their internet marketing campaigns and just drive sales there. So they tell a story. Barbie.com tells a story, tries to get kids more interactive that way. They've added some electronics to toys, but we feel that one of the biggest things that Mattel does is they relied on these toys because they have a high cost of goods, a high margin on the traditional plastic toys. Electronic toys have a lot less margin. If you look at video game manufacturers, their margin's a lot thinner than Mattel's margins. So we feel that as Mattel has weakening with their traditional toys, their margin's going to weaken if they have to go into and innovate in new toys. They're not going to have a higher margin.
Many times we as investors make the mistake where we take the historical past, so the last several years they've been struggling, Barbie's not growing, and we extrapolate that into the future and say that's just a trend and it's going to happen forever. Have you thought about more on that upside potential side, where you might be wrong? How can this company revive itself? Is there 2 or 3 initiatives that you think that they could definitely do to get going?
I think with having $1 billion of cash, I would say that using that cash again for innovation, we actually took 20 years of data, prior data, and then simulated that and used that for sales growth. So hopefully we captured some of those irregularities. But if they refuse to innovate, which is what it sounded like from conference calls, they want to do what they keep doing, they want to do it well. I think that it's advertisement and penetration of new markets, and in that sense, advertising and hitting the right crowd and pushing their products in the right way. Because I know, especially in China, there's been a lot of adversity to Barbie and some other of their dolls that they sell there. So I think that tailoring and customizing their products towards those new emerging markets is where they're going to see the most growth in sales.
I can answer a little bit of that too. In the most recent slides that they put out, they said they're going to enter a new category, and they foreshadowed it before, and then they actually told what they're going to do. They're going to enter the outdoor toy category, so they're going to try to take on Hasbro and the Nerf field. So we're not sure exactly how that's going to work out. That is something new. It's kind of an innovation. It's something they haven't done before. Another category they could get into is the educational toys. They can also enter the Lego market, construction blocks. They do have partnerships with Mega Blocks in that industry. And it's a very small part, so they could maybe acquire that company and move into that. But Lego is the dominant force in that market. So there's definitely areas they can grow in, but we're not sure if they're going to do it or if they're going to be aggressive enough to take on that leadership role.
Do you think any of their competitors are attractive companies, by the way, who did this? I mean, I know that wasn't specifically looking at it, but are their competitors better positioned, for example?
Well, Hasbro is definitely strong in the boys market, like we mentioned. They definitely have a good hold on that market. Leapfrog, we think, is very innovative with their educational digital toys, and Mattel just seems to be kind of falling behind. And as they release new products, with the girls' portfolio being their strength, we're experiencing product cannibalization, and as they try to innovate, they're just taking out from their previous sales, and it's just they seem kind of stuck. And so that's why our emerging market seems to be the only potential. But like we said, we think that will take significant years because their products are quality and of luxury.
What about the American Girl line? I heard that's supposed to be pretty successful.
Yeah, the American Girl line is doing relatively well compared to everything else, but Barbie is such a huge part of their girls' portfolio. American Girl is still significantly smaller, that we think that the negatives of Barbie are going to outweigh the positives of American Girl.
Given the heavily coordinated conversation we're having, I find it interesting that you guys use some of the power simulation model to simulate the valuation. Can you tell me some of the assumptions that were behind the model?
Yeah, what do you get into that?
Right. So basically, like I said, the main point of mine was just to get the distribution of the price range. And so, in particular to the financial data, when we look at all the averages of, say, sales, cost of goods sold, R&D, etc., we model in within a variation of what it has been and what we think it will be in the future. It was based off of management's goals and what we see is going on in the current market right now. We also did the Monte Carlo simulation, like I said, on sales because that was such a top-line driver of the whole valuation model.
Did you feel like a normal distribution model to like each of those for everyone?
It depended. It depended on the component and how it varied. We used different types. There's a type called Gen Triangle. It's not the same as just a normal distribution. It's more weighted to the center, how it typically is, like typical operations. That was our primary one because for normal distribution, it wouldn't make sense on some of the components.
We also use a uniform distribution as well. So it makes that we're harder to tell.
And so, can I follow up on that? So you projected, did you say 2 to 3.5% growth?
Correct.
Kind of what's that average? Is the average kind of like in the middle of that?
Well, no, that is an average. It starts lower and it kind of builds upon itself along the years. Basically, the way we did that is just by, like I said, linking the GDP growth. And so,
what about costs? What about on the cost side? How did that grow? Because a lot of people seem to make a big deal out of their cost control efforts, and you do see their margins improving consistently over time, which is actually pretty impressive in a non-growth
it is.
company.
And as Jason said, we don't foresee that continuing the margins as impressive as they have been because they can only cost so much. But their cost structure has been very effective. It has stayed within a very tight range. And so within the Monte Carlo simulation, we did keep that within a very tight range. We didn't want to...
So it was kind of more of a constant from where it is now?
For the most part, yes.
Very small standard deviation.
Yeah.
They did a good job of hedging.
Yeah.
But you don't think there's much in the way of improvement because some of the other, I mean, not to contrast it, but we've seen some projections in some of the other groups where they continue to feel that that will improve over time.
But we
that their margins will improve.
Right, because the cost cutting will continue.
Right, but with that, if sales do not improve, because we model sales very low, and even if they do cut costs, then if their sales, which is the top line driver, if they're not improving as they should in the industry, then their margins still don't do.
In the Mattel presentation, they do talk about raising prices, but as you can see with the slide, they haven't raised prices much, even to keep up with inflation in their core customers. So we see that as a major problem. They're just not passing on, with Walmart selling toys at discounts and everything, they're not able to pass on the price increases.
Maybe one more question for you. Can you tell me what they said in their quarterly conference call, right? Because you guys look like you're a little validated with that, right?
Yeah.
You just mentioned. Well, what happened? I mean, again, I don't know.
No, I mean, in a nutshell, no one's buying the toys they're putting out. They had really weak
That's a little
sales.
hard.
In their core brands, they had really weak figures, and the market didn't like that at all. I mean,
So how much was revenue down?
revenue was down, I think it was almost flat, but down, I want to say, maybe by 2% last year, so.
The key driver to that was North American sales were down a lot, and then international was up a little bit, not as much as they wanted it to be. So in our sales model also, we did two different sales models. So they did a GDP sales model, and then we also looked at sales model breaking down North American sales and international sales, so you can actually see how variations in those drive everything. And North America is still a huge market, so when you have a decline, it makes a big difference.
Sorry, we're out of time.
Thank you so much.
Nate, Jay, Ryan, and Isaac. We're here to talk to you about Mattel. With over $6 billion in revenue, Mattel is a leader in the global toy industry. Since its founding in 1945, the company has expanded rather rapidly and now has a number of billion-dollar brands across the globe. Despite this rapid growth, there are considerable headwinds going forward. First of all, there's considerable buyer power, or bargaining power with the buyers. For example, nearly 40% of Mattel's sales go to 3 distinct retailers. In addition, there's fierce competition amongst the players in this industry, especially to stay in front of consumer demands. Based on our analysis, we placed a buy recommendation on Mattel with a target price of $51. Now, this represents a 19% premium on the January 24th trading price of $43. Our thesis is based on 4 distinct factors. First of all, we believe that Mattel will be able to outpace growth within the toy industry, both domestically and abroad. Second of all, we believe that management will be successful in developing the operational efficiency and enhancing operational leverage, which will actually enhance the returns from this growth. Third, we believe that the management will continue their shareholder-friendly capital return policies, which represents a friendly or a high yield compared to the low interest rates in the current environment. Lastly, we believe the trading value is considerably below the intrinsic value that we calculated. We think that now represents an attractive entry point. Now, Brian will talk about the first prong, global growth opportunities.
Thanks, Steven. The key revenue drivers for the global toy industry are increasing discretionary income and population growth. Together, this will result in 250 million new families entering the middle and upper classes by 2017. We think that within this context, Mattel will be able to grow at a rate faster than the global toy industry, mainly because of their strong, experienced management team, which has shown that they're able to execute an international strategy. One example of this strong execution is the Max Steel brand, which has quickly become the #1 action hero brand in Latin America. So basically, to develop these growth brands, Mattel can go 3 different routes. First, they can just develop the products in-house and create content to go around those products, which they've been able to do very well over their history, recently with Monster High and Max Steel. Secondly, Mattel has balance sheet capabilities to acquire growth via acquisitions. Recently, this occurred with the acquisition of Hit Entertainment, which brought Mattel the Thomas & Friends property. And lastly, Mattel has developed strong and long-lasting relationships with entertainment companies, including Disney, which gives them exclusive rights to licenses to very popular products. So here's where we see the opportunity. We think there's ample room for growth in emerging markets because, as you can see, emerging markets, especially China and India, spend much less per child per year on toys than the developed world. And we think that as population growth and economic growth in the developing world outpaces that of the developed world, that we may see this gap begin to narrow, which would expand the pie for all toy manufacturers. So pulling it all together, we drive to a 5% annual revenue growth rate for Mattel in our projection. This is an aggregation of the faster growing markets, including the regions Latin America and Asia Pacific, and then the slower growing regions in Europe and North America. And now I'll hand it over to Isaac, who will talk about margin discussion.
Thanks, Brandon. So while they're pursuing top-line growth, Mattel is actually going through numerous cost-cutting programs in order to improve margins. They're currently on their third operational excellence program, where they anticipate to save $175 million to their business. These programs have been targeting both savings in growth or improvements in gross margin and reductions in SG&A. Within the gross margin, they're actually looking at process improvements and manufacturing enhancements, so that they can reduce packaging costs and actually improve their gross margin on their products. And they're also working on international clustering of their businesses so that they can continue to hit their consumers wherever they might be in a more cost-efficient way. With that projection, because these enhancements, we expect them to be able to continue to grow their top line while maintaining their costs on a fixed dollar amount. So we expect margins to continue to grow going forward. And with that, we expect them to grow from about 16%, which they did in 2012, to 22% by 2017. Mattel also has very shareholder-friendly policies, and we think the management is experienced and realizes the fiscal discipline that comes with these policies. But they've actually had double-digit dividend growth for 8 of the last 10 years. This past year, they've actually returned approximately $500 million to shareholders through dividends. But they've actually done this while maintaining a very healthy share repurchase program, which we expect will continue into the future. As you can see on the graph on the left, they actually this past year have returned approximately $400 million through repurchases while maintaining that dividend policy. Going forward, we expect management guidance is a targeted dividend payout ratio of 50 to 60% of prior year earnings, and we're optimistic about the value of that going forward. And next, Vijay will talk to you about valuations.
Thank you. Mattel's strong growth opportunities abroad, as well as their cost savings program, lead us to an attractive valuation for Mattel at $51, which is 19% upside. For valuation, we use 2 broad methodologies: discounted cash flow analysis, as well as market multiples for related companies. We took an average price listed by each of these methods and arrived at $51 intrinsic value. For the DCF, we projected a 5% CAGR for the top line. We arrived at this estimate by looking at various segments of Mattel's revenue and also including the American Girl brand, apart from various geographies. And we expect a 2.6% improvement in the gross margin. This is, Mattel has delivered consistently in their operational excellence program in the past years, as well as we expect a positive outlook for the operational excellence 3.0. And we calculated the terminal value using 2 standard approaches, and to sort of stress test the valuation, we used a sensitivity analysis of 3 important variables. We got a whole range of prices, took an average, and arrived at an intrinsic DCF value of $58.82, which is significantly upward to their current trading price. And now Nate will talk about comparable company valuations.
So what we did for valuing this company by looking at peers was we used 2 separate methods, and then we took the average of the 2 methods. So our first method was we created a peer group, and we did this by taking 4 global toy companies, and we also added 7 global portfolio management companies. We thought had a similar business model to Mattel. We're growing at similar rates, at similar amounts of leverage, and at similar profit margins. And we chose a mix of consumer discretionary and consumer staple companies because in our mind, Mattel's toys are someplace in between in terms of sensitivity to economic cycles. So if you look at $80 jeans would be more sensitive to economic cycles than toys, which would be more sensitive than, say, light bulbs from PG&E. Those are all in comfort. And what we did was we took the median next 12-month PE ratio from this peer set, and that took us to a multiple of 15.9 times. So that was the first method. The second method we used was quite different. What we did was we looked kind of around the toy industry, and we saw that one comp stood out from the rest by far, and that was Hasbro in terms of how they run their business. It's very similar to Mattel. Is that 1 minute? Oh no. And we looked at kind of how these 2 companies have been valued historically, and particularly over the previous 2 years, and kind of differential in terms of what multiples they traded at between the 2. And we found that over the last 2 years, Mattel traded at a 4% premium in terms of their next 12-month PE ratio to Hasbro. And we think that that is justified because of Mattel's higher profit margins, higher historical and forecasted growth rate, and lower leverage, and it's got better scale. It's got scale advantages over Hasbro as well. So it's got roughly twice the size. Now, that 4% premium was historically over an average over the last 2 years. But currently, what happened is Mattel drifted down to roughly 11% discount to Hasbro. We think that there's going to be some reversion to the mean there, so we took the 4% premium, applied it to Hasbro's current next 12-month PE ratio to get a multiple of 16.3 times. So we took the 16.3 times from the second method, 15.9 from the first method, averaged them to get 16.1 times, and that gave us a share price of $48.34. So I'm also going to talk about some of the risks in Mattel right now. I've laid out 6 of the major risks that people look at, but I'm really going to focus on the top 2 because that's what generally many people consider to be the biggest threat to Mattel. I'm going to talk about why they're mitigated. Meeting consumer demands is a risk that all toy companies face, and I'm going to talk about, and Mattel has a stronger track record than any toy company in history with meeting these demands. The main reason is that it's one of their core competencies. They've got intelligence in developing brands, marketing brands, and selling is what they do. And they've also diversified this risk across a number of different revenue streams through different brands and geographies where they sell the products. Second risk I want to look at is litigation risk. And with that, I'm specifically talking about MGA's $1 billion lawsuit they brought to Mattel roughly a month ago, where it's going back to some misconduct that Mattel was accused of back in the earlier part of last decade. And to make a long story short, we did some research on that, and we believe that there's roughly $170 to $200 million ceiling on what the results of that litigation will be, and therefore we think that major risk is mitigated as well.
Sorry, we're running out of time.
Okay, Steve. All right, and we'd like to open up the floor to questions.
One question. If you look at the key group method, so on one hand you're using some global brands, and on the other hand you're using global toy companies. What's the difference? What's the PE, the market multiple difference between those 2 methods? How different are they?
So we actually, what we did was I was just breaking that up so you can see what the components of our peer group was. Our peer group was that whole group.
Right.
So we included, in general, the toy companies were a little bit more scattered because of the different sizes. Namco, Bandai, and Hasbro are larger, which are lower multiples than Jack Pacific, which trade at a higher multiple. But the global portfolio managers trade generally in the mid to high teens, and that's kind of what we tell us more like them than they are, even though they're toy companies, than they are like the smaller toy companies.
You commented that they have a strong track record as far as competitive intelligence and sales. Unfortunately, there seems to be a lot of uncertainty about Mattel's ability to respond to it. It looks like a change.
Yeah, well, I think in Mattel's, a big growth opportunity we see is really the Max Steel brand. That's something that we see as the future, is creating brands and then being able to deploy them to other parts of the world. So we recently saw that in 2000s with Max Steel in Latin America, which are now bringing back to the US. But it's also a multimedia content side that Mattel, we think, has a distinct advantage, which is actually a motion picture they're talking about with Max Steel, similar to a Lego movie, where they'll be able to spur demand by going and reaching the consumers with new and innovative content. So something that we also see within the Monster High space, where they're releasing not only the dolls, but content. Because we think that at the core, content drives product sales. So if you don't have relevant content, you don't have sales. And we think Mattel does content very well.
Who are they doing these? So we're talking about movie deals or video deals? Or, I mean, is there any detail there? I mean,
With Monster High, they were doing YouTube channels, and they have content on their website where they're trying to draw consumers into a website. So a lot of it's web-based and a lower production value. With Max Steel, they are looking at a larger, more produced product.
like a movie, like a Lego thing.
Yes, yeah.
Most of the growth is international, right, that we see going forward. And they have a pretty distinct operation when they go into each country, trying to kind of curry favor and enable the brand before they actually start distributing and enter that country.
So,
Oh, sorry.
I was just gonna ask them in DCF model, the 5% top line goal seems fairly aggressive given where they've been and the percent of their revenue that's currently coming from domestic. Can you explain your reasoning in terms of?
Yeah. So with the revenue projection, we basically looked at historical, for the two most growing, which is Asia Pacific and Latin America, we looked at disposable income trends and the growth in those, and kind of the correlation between disposable income trends and toy purchases. So in both Asia Pacific and Latin America, there's considerable increase in disposable income projected by the OECD, and so we kind of use that as a benchmark. As far as for North America and Europe, most of the European growth that we have modeled there is based on Russia and Turkey, and so the Eastern European economies. We think Western Europe is going to be pretty stagnant for the next year or so because of the economic situation there. North America specifically is supposed to be, which projected the toy market there is projected to be pretty stagnant, but we tell us traditionally outperformed by 1 or 2% as far as the growth. So we took that past outperformance and used that as a model for going forward.
Are these all equally weighted, or did you put it as weight?
They're-
Did you assume growth rates because you share in different markets?
Exactly. It's weighted by their current positions in each of those markets.
Can you talk about the sensitivity of like the Gordon growth model and the DCF, the changes in those rates, right? Because you didn't just do a point estimate, right? You looked at some distributions about what happens if growth rates are higher, lower, how's the price going to change?
Yes.
Okay.
So we performed initially a sensitivity analysis for the top line growth. We sort of modeled it from like around 4%, like around 6%, and then we also performed primarily on these three parameters, which is like the terminal growth rate. We sensitized it from like around 1.5% to around like 3%, and then for the EV/EBITDA multiple, we took it from 11 to around 14, and for the WACC, it was around from 7.5 to 9%.
And what does the distribution look like after that's all said and done?
So
fair price.
So this is the range, the lowest and the highest.
I'm sorry. All right. Yeah.
And we just took an average of all these things to.
So how are you choosing the tags multiple in the range of 11 to 14? It seemed that the slide showed earlier they were much lower.
Yes. Initially, we took the exit multiple based on our projections for next year, and then we also looked at historical averages. And therefore we performed a sensitivity analysis around that to see, based on our projections, given that it's a strong company, whether it's going to be justified or based on historical rates. We see like sort of a hit on that, and that's how we ran at that range.
By nature of them being undervalued right now, we think that the multiple, if you look at today's EV multiple, would be lower than if you look at the historical average. So we said, if we're looking at terminal multiple, you kind of look at kind of a longer term range with that one.
You know that Kit Anakin was in some transition. How does that make them employee going forward? Is that only reflected also on the top? I would not see that on the first. What companies
They mentioned, and I guess something we're concerned about, but optimistic about, is potential acquisitions, because some of the pricing right now, they mentioned that they're concerned about doing an acquisition at an unfair price. So we're trying to be opportunistic about the companies that they pursue. With that being said, construction toys have been a big growth area. Lego has been growing very rapidly. So there are companies that we would be optimistic in something in that space because they're not competing as strong in the construction business, and that internationally is selling very well. So something that if they were looking at an acquisition target for the right price, construction would be an area that we think would enhance their business. But with that being said, for us, a very important factor is the price that they do the acquisition at, since they do have the ability to build brands as well.
You didn't focus much on the balance sheet in here. Do you guys look at the leverage at all as far as the amount of debt the company has? And do you think they have enough debt, or do you think potentially they could even take on more? Did you look at that at all?
Yeah, I think their debt to capital has been increasing a little bit over time. I think they did a very good job financial management over the past few years. They refinanced and reduced their interest rates. I think they have a bit of room for increased leverage, but I think the CFO has done a very good job so far.
We also use that in our capital calculations, and then found that it's also, to answer your question about whether they have more room to take debt, they are currently having lesser debt than Hasbro. So obviously, they have like significant leverage.
They produce a lot of cash.
dividend payout ratio, you say is 50-60% of prior earnings. So I think we should assume that the dividend growth rate is going to decrease, because that's, you say 50-60% is getting pretty high.
Yeah, I think it is. I think it would decrease over time. I think they do have room to improve though, since they are at the same time doing a lot of share repurchases. So that's going to give them a little buffer room while they increase net income over time, but to continue above average dividend growth rate. At some point though, that would need to come down. Double digit isn't sustainable based on their current growth rates. But since it's simultaneous with the share repurchase, we think that they could potentially reallocate something like it.
Fair enough. You think kids are getting older or dumber?
Yeah, that is a major concern that Mattel has addressed, and you know, I think that just the way they mitigate that risk is really through driving content too. I think you know, in today's world, it's not enough just to make a toy. There's a mobile app and a web series that goes along with it. So they've really done a good job at kind of creating the universe around their toys, so it doesn't get too stale. Especially with brands like Barbie, it's, you know, been around for 50 years. They really need to continue just driving interest.
What are they doing in terms of digital? Besides just blogs and websites?
I would say it's a lot of just either expanding on the toy brands that they have, just creating more content where there might not have been, you know, 10 years ago, or also just when they target developing new brands, really starting out with the digital push, starting out with like either like a web video or music video or something like that, just to drive interest that way, and then selling toys from there.
I'll add to that is that they've learned a lesson from a prior failed acquisition of a TLC company. Since then, so it was a massively dilutive acquisition. They lost lots of money on it, and since that point, they kind of decided, we're a toy company. This is what we do. We make toys cheap and we sell them with a fat margin, and we're going to stick to that business. And it's an example from kind of like an app you guys can relate to. The Angry Birds franchise can tell me more money selling the Angry Birds toys, plastic toys, with that content than they actually did selling the Angry Birds app. So, you know, people talk about iPads and kids, you know, getting the content that way. Mattel can profit off that through that content. So,
sorry, we're out of time.
Thank you.